Okay, what we're going to talk today is about investing in bonds. So you could become part owner of a company by becoming a stockholder. But we can also earn money by lending money to the government or some sort of company. And what we get in return for lending the money is interest. And all of the money that you lend, you'll get back. So a bond is nothing more than some sort of IOU from a company or some sort of lender. When you invest in a bond, the bond you buy shows the amount of money being borrowed. So you're going to lend a certain amount of money, and that's the amount of the bond, and that's called the face value. And the interest rate is also called as the coupon rate or the yield, and that's what the borrower, the company or the government, will pay you in interest payments, or also known as coupon payments, at the end when it matures, when your bond matures. So that's the deadline for that you set when they will pay you back. So we're going to read bond tables. So we're going to go through this example. So the first column is the company or the country that is issuing the bond. The second column is the fixed interest rate that the issuer pays the lender. So this is the rate that they're saying, we're going to pay you this percentage interest rate. The maturity date is the next column, and that's the date in which the borrower will pay back the original money that was lent, the date of the IOU. The bid money is the price that someone's willing to pay for that bond, and it's in relation to 100. And then the yield, and that's the percent, the annual return until the bond matures. Of course, you'd want a higher yield rate. Okay, so Miles wants to invest in $10,000 for his children's education of 5-year toys corporation bond. If the coupon rate of the bond is 7.5 paid semi-annually, so it's paid twice a year. So how much will Miles receive semi-annually? Well, his interest is just PRT. So we can see interest is P times R times T. P is the original money that is being invested. R is your rate. And we're going to put our rate in decimal form, and T is our time in years. And so we're going to see how much is paid semi-annually. So that's a half of a year. We're going to see how much interest rate he gets in a half a year. So every half year he gets $375, and he'll get that for 5 years because the bond is a 5-year bond. So Part B says, what is the total return on the investment? So the return is how much you get back. So the total return in the 5 years, we're going to plug in T equals 5 into our formula, and we can calculate the total amount of interest that we earn over the 5-year period. So it's $10,000 at 7.5% interest for a 5-year period of time, which is $3,750. So if he keeps his bond for the full 5 years, he will be returned the $10,000 that he lent plus $3,750 in interest, and it's paid out semi-annually, so he'll get those chunks twice a year. Okay, so there's advantages and disadvantages, so I'd like you to pause and read through the advantages and disadvantages. Okay, so hopefully you've jotted down some of the advantages and disadvantages. One advantage of stocks is that they usually outperform, say, banks. And you can vote in a company. So you have the potential for earning more. Of course, the disadvantage is that prices go up and down, so you could lose some or all of your money. Bonds, on the other hand, they have higher interest rates, and they have less risk compared to stocks. So it's higher than a bank, but less risk. A disadvantage is that your money is tied up for a certain period of time. So if you want to take your money out before the end of your time period, before your bond matures, then you can get a loss. You have to pay what they call a discount. Okay, so next up is investing in mutual funds. So a mutual fund is a pool of many investors who pay someone, a professional manager, to purchase a variety of investments. So it's many, many people coming together. You have some person, this manager, managing a variety of investments. And there's thousands of mutual funds to choose from in a variety of needs and objectives, meaning high risk, low risk, and so on. So the most common type of a mutual fund is something called an open-ended, where there's an unlimited number of shares that can be issued. So many, many, many people, an unlimited number of investors can come together And the more investors that put into the fund, the more shares it issues. So it just becomes a larger sort of open-ended. So what we're going to do is we're going to read the tables for the mutual funds and talks about those. So the first two columns is the 52-week high and the 52-week low, and that's for the particular fund. Then you have the name of the mutual fund and the name of the company that managed the fund written above it in bold type. So we can see Bolton Funds is a company and it manages these funds. And then you have Select Funds manages those three funds. The next column for the SPEC is the fund specifics. So it fits retirement, eligible, or the N for no load, F for it's a front load, B for both front and back end fees. So just very specifics to the type of fund. Then the next column would be the dollar change from the previous day, as well as the percent change from the previous day. So the NAVs, so Friday NAVs, PS, we'll talk more about the NAVs, that's the net asset value. So you have the dollar change and the percent change. And so that's from before versus weekly. You have your high and low. So that's the highest and lowest the fund traded during the last week. What it closed at the last time that the fund was traded. And then you have your dollar change in price over the week as well as the percent change in over the week. Okay, so jot all those down and then we'll move on. So we're going to talk about the net asset value, the NAV. So the net asset value is A, which is the total fund assets. We're going to subtract off the liabilities, and then we're going to divide by the number of outstanding shares. So remember, like if you had an open-ended fund, you could keep issuing more and more shares. So it's the total number of shares, which corresponds to how many shares that investors have in this particular fund. Okay, so here is an example. We have the ABC Mutual Fund with $400 million worth of stocks, $200 in bonds, $500,000 in other assets. It has total liabilities of $10 million, and there are 20 million outstanding shares. So we're going to find the NAV for one share, and then we're going to calculate how many shares can you buy with $100,000. Okay, so the assets. We had the 400 million, the 200 million, and the 500,000. So remember, we had 400 million and 200 million. So I just wrote those out with all the zeros plus the 500,000. So we had 600 million, 500,000 in assets. And then you had $10 million in liabilities, and there were 20 million shares. So we can calculate our NAVs based on the givens. So our assets, which were given in the problem, we just had to sum up the three. We're going to subtract off the liabilities and subtract and divide by the number of shares. And we get $29.52, 52.5 cents. So this is the NAV, the net asset value for one share. So it's kind of like the cost of a share. And so if you have $100,000, how many shares can we buy? So we are just going to divide. And in this particular example, when we divide how much money we have divided by how much it costs per share, we're going to have to round down because we don't quite have enough for 3,387. So we can only buy 3,386 shares. So we're going to round down for the real world problem here. Okay. So there's three ways you can make money in a mutual fund. By the capital appreciation, that's when the NAV value goes up. So it's kind of like your stock value going up. So the mutual fund price goes up. By receiving a portion of a dividend. So some stocks will pay dividends. And if there's a stock that pays dividends, part of your mutual fund, then you can get a dividend check. Plus, also when you sell your mutual funds, you can get your capital gains distribution. That's your profits when you sell them. So we're going to go through an example where we're going to calculate the capital appreciation, the yield percentage, as well as our percent returned. So in this example, an investor buys 100 shares of the math fund, of course, at $80 per share, and a year later she sells them for $90 per share. If she received an income distribution of $2.50 per share, we're going to find the capital appreciation, the yield, and the return. So to find the capital appreciation, the formula is the change in the NAV price. So that's what you bought your mutual fund for versus when you sold them for, and then the number of shares you had. So if we bought our mutual fund for $80 and we sold them for $90 and we bought 100 of those shares, we get a 10% capital appreciation, and it's given in a percent. So here is the capital appreciation. This is the percent, the return on our investment, because we bought it for 80, sold it for 90, and we bought 100 shares. So we have a 10% capital appreciation. We can calculate the yield percentage, and that's the distribution per share divided by the NAV at the time of the sell. So our distributions were given in the problem at $2.50, and at the time of the sale, it was $90. So it was a 2.78% yield on our investment. To calculate the return, we're going to calculate the increase in our value. So we sold it at 90, bought it at 80, and we had 100 shares. So the $10 times 100 is our 1,000. And the distribution was $2.50 per share, or $250 for our total distribution of our 100 shares. So the return percentage is the increase in value plus the distribution. So the increase in value was our $1,000 because it was an increase in $10 per share in our $100. And our distribution was $2.50 times 100 shares, which is your 250. And we're going to divide that by the cost of the initial investment. So we initially invested, it was $80 a share, and we had 100 shares to give us our initial investment cost of $8,000. So when we divide those numbers, we get 15.63%. Okay, so let's get back to advantages and disadvantages of mutual funds. So 3 main advantages of a mutual fund is professionally managed. Somebody who is an expert, supposedly in the field, is managing your money. They take your money and they put it into a diversified mutual fund, meaning it's not just putting all of your eggs into one basket. The mutual fund has many, many different stocks and bonds perhaps in them. So if one company loses money, something else might gain in money, so it's diversified, so it's really more well balanced. Mutual funds are very liquid. You can just call up your professional manager of your money and say, I need some cash. Can you sell some of my stocks? And they can sell some, and then you can get your money back. A disadvantage is it costs money to have someone manage your money. You have to pay them. Sometimes there's hidden costs, and so unless you are really into reading the fine print and understanding fully of what's going on, there might be some hidden taxes, some that you didn't necessarily know about because your manager didn't tell you about these, as well as some other hidden costs that you don't know about. Okay, and that is what I wanted to tell you about mutual funds.